We're going to stick on the theme of blockchain and technology, and we have some really great speakers coming up. We're just going to give a few more minutes to empty the room and to let people come in. Now, if you are sitting down already, if you're going to stay here, we would really appreciate if you could move towards the middle, because that means when people come in, they will be able to find a seat without tripping over your bag and knocking over your coffee. So that would be much appreciated. If you would like to get involved with the conversation online, please do. We really, really appreciate and encourage interaction on social media. Just remember to use the right hashtag, and that is hashtag SouthSummit18. So SouthSummit18. And please feel free to connect with the speakers on LinkedIn, to tag the speakers on Instagram, on Twitter, on any social media platforms that you're using, and let's keep the conversation going. I believe we have somewhere between 12,000 and 14,000 delegates who have registered for South Summit this year. So that's an enormous amount of people that can change your life. That could, you know, amongst those 14,000 people could be the one person that takes your business to the next level, that partner you've been looking for, that VC who's going to give you the funding to make it all happen for you. So this is a tremendously exciting few days, and it's a real privilege to be involved. If we didn't meet earlier, my name is Oisin Lunny. I'm Chief Evangelist at Open Market, and we're a company that helps the world's largest brands connect with their customers in the moments when it counts by using empathetic interactions. And if anybody would like to find out a bit more about empathetic interactions, I'd be happy to share my TEDx talk with you all about that, which I gave in the US last year. Okay, so I think everybody's out and everybody's in. We've still got a full house, which is fantastic. So our next session is all about how the blockchain technology is making the financial sector more democratic. So an incredibly exciting and current topic. And so please join me in welcoming to the stage Tara Kemlin-Jones from TCJ FinTech Advisory and Bundeep Rangar, the CEO and Chairman of Premfina. Please welcome our speakers to the stage. Thank you. Yeah.
Well, for those who've seen me earlier, hello again. And I'm here with Bundeep, who was born in India, brought up in Canada, and now lives in London. So I think global is going to be part of the theme. And what Bundeep would like to talk to you today mostly about is financial inclusion. That's a key topic for you. And obviously, as the title suggests, you believe that blockchain is going to be instrumental in terms of promoting financial inclusion.
Yeah, Tara, thank you for that. So I think this is a Commonwealth kid is what I am, right? So and in some ways, that's where the connectivity that I look at comes from. So, you know, I think it's democratization of financial services, it's the access and financial inclusion that's propagated by the blockchain. Do people get what the blockchain's about? Because sometimes I talk and then people ask me later, oh, can you just explain blockchain to me? And then I go like, okay, let's go back to 101.
You can put your hands up. So yes, no. No hands up.
Okay, so let me explain, just to make sure we get the basics right. So the internet was built around a communications protocol, right? So the HTTP, all the various things that we're used to, TCP/IP, are all ways of communicating content. And the issue with content is, while it's very effective and it's created a way for us to globally communicate, if I send an email to you, Tara, and I send it to two people at the back of the room, I still have a copy of the email. So I'm transferring content, and I'm retaining a copy of the content. If I want to conduct a transaction on the blockchain, if I want to exchange value, and the unit of value is a currency, if I gave you a $50 or a £50 or a €50 note, I better not have the copy of the same myself. Right? So I can't have a replication of that content in a transaction exchange. So the only way to do that is by having a ledger entry. In my personal ledger, I have a debit, and in your personal ledger, you have a credit. Guess what that is? That's a ledger technology. Now, blockchain is just the kind of colloquial expression for what is actually the distributed ledger technology. What does distributed mean here? It means that when this entry is made, and I record a negative on my side and a positive in yours, it's then recorded on millions of computers out there. And those computers preserve that in perpetuity in an immutable, i.e. unalterable form, that transaction. And if anybody has to verify it, they go back and it's confirmed by those millions of computers. So that builds one central part of what the blockchain is, which is trust, right? And if you then look at financial services, trust is an intrinsic part of what makes a financial services work. Ultimately, it's brand, which is basically a repository of trust. Stepping back for a second, when I'm transferring this money to you and I'm transferring value to you, that's recorded. How do you create a system whereby there's economic incentives to preserve that computational algorithm and the record of the transaction? So the blockchain has this notion of mining. And miners are not miners digging for gold and platinum. They're effectively incentivized to get a small fraction of the cryptocurrency created as a consequence of preserving that transaction. So they're economically remunerated to keep forever a record of the transaction, and thereby, as they increase more computing power, more mining, they get more rewards. So there's a built-in, and you know, by the way, we're a few months away from 10 years of guess what? Anyone?
10 years of January 3rd, when Bitcoin...
Fab, absolutely. So you know what? We're 10 years into one of the most revolutionary changes in our lifetime. This is a dimensional shift. It's not just an incremental shift. Of all the things out there, whether it's IoT, AI, robotics, this is the most pervasive. And the reason for that is, you look at human behavior, human interaction in financial services, an offshoot of that. Anybody familiar with the Dunbar number? Yeah. Go ahead, please. 150, right? So the Dunbar number says that humans are able to create socially cohesive relationships with up to 150 other people, or a total of 150, because that's the limit at which humans can have a cognitive ability to retain knowledge about somebody else. When humans emerged from that initial stage, they created mechanisms for authority that maintained that relationship with other people, not independent sort of peer-to-peer, but across a central authority. Rousseau came along and said, you know what, we'll surrender some of our sovereignty to a central authority in exchange for giving us more trust and security. Mm-hmm. Well, those systems are great, but they don't scale. Mm-hmm. They don't create worldwide Commonwealth kid type of scenarios where you want to connect with people back in India or Canada. Mm-hmm. There's an inherent lack of trust. And what happens in the financial services world and in most other worlds, like political worlds, you create intermediaries that are basically nodes of trust along the way. And those intermediaries, of course, then become possible pilfers because they can bleed out money. And of course, more layers you have, one fundamental premise in financial transactions is the more times you touch a transaction, the less money you make because somebody else is making money along the way. And the founders of PayPal use that mantra to say we want to be right at where money is transacted because that's when where the most money is made. Now, if I look at blockchain and where it affects my world, I can think of 3 use case scenarios where blockchain becomes really meaningful, right? So the first one is money transfers. Today, if you send money across to any part of the world, you know, there's an article in the New York Times yesterday that said the Australian regulators coming down on the banks in Australia because they're charging 7.65% on average for a cross-border money transfer.
It's pretty bad here as well.
Right. Okay. And that was 14% more than the UK and 40% more than the United States. The average is still 7%. Well, think about a transfer on the blockchain. If I'm transferring you money, the blockchain is agnostic to borders. It doesn't matter if you're sitting next to me or sitting in Beijing. All what I'm doing is putting a debit on my ledger here and giving you a credit there. I don't need those intermediaries because guess what? The trust is intrinsic in the network. The whole blockchain network is built upon trust, and trust makes business efficient. Mm-hmm. So if I can create a system whereby I don't need these intermediaries, I don't need banks and Western Union and whoever else to create that transaction. And by the way, that gives me a 7% cost saving. Right? Let's look at the other part of this, which is the unbanked world. There's 2 billion people in this world today who are not part of the financial world because they don't have a bank account. 20% of them, 400 million, are in South America. Right? There's 25 countries where 75% of those 2 billion people who don't have a bank account, thereby can't get a credit, can't get a credit card, can't get loans, can't get a paycheck. So when I create an ID around blockchain, that's my blockchain wallet, I basically have given myself an ID. And that's my unique identifier globally. That's also very, very efficient for something else we do in financial services, which is KYC. I can upload my KYC documents there, and with my two keys, my public key and my private key, decide who to give access to, thereby making financial inclusion much more possible, and the cost of transactions a lot lower. So the consequences of this are huge. So my company is an insurance financier. We raised money from Rakuten and Draper, and one of the things that we did was we want to break down the cost of insurance. Now, the insurance world to me is one of the things that comes up in every single blockchain conference as one industry ripe for disruption by blockchain. Because guess what? It is fundamentally a digital economy. We're not selling goods, we're not selling products. It's about financial calculations of risk and syndicating of risk. Who here knows about tokens? A token is a fractional ownership of risk.
Yes.
And that's exactly what insurance is, right? So I go on forever, so tell me when to stop.
No, this is all very interesting, but just to tie it into some of the themes that have been going around the conference at the moment. In Spain at the moment, there's been a slight issue with regulation. Cabify is one of I don't know whether it's one of the Spanish unicorns, and obviously, as these companies grow, as we've seen with Airbnb, the regulation in different countries changes. Obviously, we're talking about different industries, but
right.
Coming to the distributed ledger, coming to ICOs,
right.
We understand the uses of the distributed ledger, we can understand the advantages, and even how it promotes financial inclusion.
Right.
But the problem is, if you get sort of speculation on cryptocurrencies, that's going to bring the regulators in. Obviously, in the US, they've looked at it very closely. In China, they've just decided to ban them completely. What is your feeling about how this fits in with the regulatory environment as it currently stands?
Right. So regulators are really interesting because that's part of that social contract, right? We've given the regulators authority over our lives, but technology is always 2 steps ahead of what rules are being written by the regulator. And the problem with the blockchain and the regulators and government and banks is that it challenges all of the above. Right? It says, why is a regulator telling me I can't invest in this company because I'm not worth $100,000 in net asset value because I'm not an accredited investor, even though it's a biotech company and guess what my PhD is in? There's a fundamental mismatch in what regulators are using as a criteria for me to be protected. Well, who gave the right for them to protect me? And why is that protection based on my economic worth in a system that has got trust taken away from me? So if you think of the blockchain and what it does for the world, it's fundamentally altering the basis of our society. And that's why it's so revolutionary. The hardest thing to open for a crypto company in the UK today is a bank account, right? Because the banks will resist us, right? But there are other jurisdictions, Malta being one, Gibraltar being another, where there are people who are more progressive and saying, this is going to happen. It's a matter of time. Facebook, guess who they hired most recently to lead their blockchain team? A payments person. Guess why? Facebook flip-flopped as well. At one time, they banned crypto ads. Then they said, know what? We will actually have crypto ads in there. The word on the street is they'll come up with a coin because they don't have the equivalent of a PayPal that eBay has. And the blockchain crypto coin, Facebook will be, notwithstanding recent events, still a fairly trusted brand. They've got 1 million eyeballs. They'll make something happen. And borderless transactions make sense for them. Starbucks has just got investment in from ICE, which owns the New York Stock Exchange, to do, guess what? A Starbucks coin, right? This is not that far from a voucher or a discount coupon we get today. So the notion of currency is different from what wealth is. And we sometimes get caught up in the euphoria of 2017 and the rise of the Bitcoin price and forget the fundamental change taking place right now. So I was in Silicon Valley about 3 weeks ago talking with some top crypto experts at Goldman Sachs, and they said like every single day they see new innovation coming. And while the market is diverted and the SEC is looking at whether they should approve an ETF or not, at the back end, new models are coming up. The transaction processing speeds are going up, the security layers are going up, and consequently, the experience of someone doing a Bitcoin transfer today is a hell of a lot better than it was last year, and it should be a lot better in 2 years from now. How many people here, by the way, own cryptocurrencies?
Yes, I was going to ask that.
I'd love to get a snapshot of that and do another in 5 years from now.
But then more and more people admit to it. So yeah, I mean, but what you're saying is that the coin is here to stay, that this is an alternative currency which will appear in various different forms, and that the regulators just have to keep up.
And you look at all disruption, they happen in a manner that ignores the regulator, because if you always follow the regulator, you'll never innovate, right? Skype did that. Airbnb did that, Uber did that. So, they will take on the regulators, and the challenge for technological innovators is to be 2 steps ahead at all times. So by the time the regulators get down to writing the rules, they're kind of already in past tense.
Okay.
And I think that's kind of where I see the crypto world going.
Well, that sort of fits in with what people have said today, so you're in good company. But I took you away from insurance, and maybe we should go back to insurance a bit and how you're going to disrupt the...
So as a case study, right, for example. So the insurance world, I don't come from the insurance world, even though I have an insurtech startup, so I've got a very outsider's view on things, which is sometimes helpful. So the way I look at insurance, you have insurance companies are like manufacturers. They manufacture policies, and the policies are basically categorizing large groups of people and saying, this demograph, this postcode, and this income group has this risk profile, so we'll create a pool for them, we'll create an insurance scheme for them. They then go to what are called managing general agents, who are basically wholesalers or distributors. They take those policies, they then go down the value chain, and they go to insurance brokers, who are basically retailers. Then the end customer is you, or me, or a company. So if you think of it that way, you've got insurance companies manufacturing policies calculated by actuarials based on risk profiles. Well, that whole industry is changing on both fronts. You don't need humans to calculate risk when algorithms can do it. We've seen that in the fintech world, we've seen that with Airbnb, we've seen that with several other startups. So risk can be calculated by algorithms, it can be priced by algorithms, and thereby it can be fractionally syndicated and create a fractional ownership of that risk, which is basically what happens today with insurance. There's companies out there that'll take insurance schemes and syndicate that out to a bunch of investors and say, this is our expected likelihood of loss, this is the severity of loss, and based on that, this is the premium we're willing to pay. Hence, it's called an insurance premium. Because I was always wondering, why is this called a premium? Right? That's the answer.
Okay, so
now,
I mean, I get that.
Right.
You get the algorithms. How does that fit in with the distributed ledger?
Because you can create a fractional ownership through a token.
Okay.
So you can create a token for a life insurance scheme of people above X number of age or living in a certain area. A token, therefore, gives you the economic incentive on the economic remuneration of that premium fractionally paid out. It's the most efficient way of syndicating that risk, right? On the other hand, you look at what's happening to us today. We have a credit rating because it's based on our spending habits and the likelihood of us repaying that back. I believe in due course we'll have an insurance rating. Because why? We are getting our driving records all mapped out on big data. Telematics is capturing everything from how we drive, when we drive, and how the vehicle's driven. We then have a smart home that's capturing carbon monoxide levels, that's capturing water leakage levels, it's capturing the level of insulation in my house, my bills. I can then match that to my Vitality Fitbit device that says my blood pressure, my sugar levels, my level of activities are optimized for my age bracket. All of a sudden, I'm getting much more customized and individualized in terms of my profile. You can then go on a reverse auction site and, you know what, I don't want to be cubbyholed in your schemes you came up with based on data from the 1950s when populations died a lot sooner and people had different lifestyle habits. I want this to be customized for me today as a millennial and where that post-millennial generation is going, and let the insurance companies bid for me. And if there's pools of risk that can match mine, let them be syndicated. And that can happen in pretty real time.
Yeah.
The data being captured is so intense and so extensive, and processing powers are so high that the calculations of risk and syndicating of risk, Lloyd should be doing this. But guess what? They're not. Hence, there's room for a startup. And there's 2-3 companies out there. Etherisk is one that's doing it. Black Insurance is another one. They're taking on the large players because insurance is ripe for that.
Okay, so we've got very little time left.
Sure.
And just to go back to the theme, looking 10 years into the future, what do you think is going to be most important about promoting financial inclusion? What areas of technology are going to most help financial inclusion or making the financial services system more democratic? I mean, you invest in so many things, you know, from films and Bollywood to, you know, Canada to Europe. Generally, it doesn't have to be specifically distributed ledger. Generally.
I think the most important advancement for that new pervasive form of economic interaction is going to be the underlying infrastructure.
Okay.
Once you get to the point where the processing powers, the speed, the security levels are just so high, then all the things that sit on the nodes, whether they're devices, whether they're transaction protocols, payment protocols, it's like the internet back in 1998.
So you're talking quantum computing, or are we talking...
Which takes it to a whole different level completely, right?
Okay,
But
so
even
processing power, or...
Bitcoin was improved upon by Ethereum. Ethereum created something called a smart contract, which creates an actionable event. It's an if-then. By the way, if you ever want to understand a smart contract, which is not really a contract, it's just a piece of code about 600 characters, think of a vending machine. If you put a €1 coin and you get a can of Coke, that's a smart contract. You put 90 cents, it's not going to be active. It's not going to action an event. A smart contract is simply an actionable event embedded in code.
I'm going to bring you back. Three
So,
things to leave.
So I would say the adoption of mainstay coins as investable commodities on a stock exchange, so an ETF and stage 2. Next generation protocols beyond EOS, which is the one that's past Ethereum, which just makes it ubiquitous for us to do pervasive computing, and then the individual customization of our data on devices that is visible to everybody on the blockchain.
Okay. Mandeep, thank you. That was fascinating. Thank you very much indeed for listening to us.
Absolutely.